Divorce is hard. Cross-border divorce is a maze, and in that maze, the Minotaur has a name: double taxation. I'm Simon Dippenaar, attorney. Today, we put a blade to the knot. How to keep the same money from being taxed twice, once abroad and then once by SARS. Here's the battlefield. You're a South African, your ex lives overseas. There's maintenance flowing one way, pensions the other, and assets scattered like chess pieces. London flat, Frankfurt ETF, Perth retirement fund. Every country wants a slice. If you don't plan, they take the loaf. Where double tax ambushes you. Cross-border maintenance. Payer in South Africa, recipient abroad, or the reverse. Offshore assets in a settlement. Property, shares, funds. Foreign pensions paid into South Africa. Capital gains triggered in two jurisdictions on the same asset. Classic example, a South African pays maintenance to an ex in the UK. South Africa taxes worldwide income. UK may tax what the recipient receives. One payment, two hands. That's the trap. The shield, Double Taxation Agreements, DTAs. Treaties that decide who gets first rights to tax a specific stream. Maintenance, pensions, capital gains. Apply the treaty correctly and you cut the second tax down or claim a credit. Apply it badly and you bleed cash for no reason. How DTAs usually split the load. Watch the details. Maintenance, sometimes taxed where the recipient lives. Other treaties lean towards the payer's country. Read the article. Terms matter. Pensions and annuities can be taxed in the source country or the country of residence, or split by type, government versus private. Capital gains, often taxed where the asset sits, property in Mauritius, shares listed in New York, while South Africa still looks at your worldwide income. When that happens, you typically claim a foreign tax credit from SARS. Sounds elegant. In practice, SARS requires full disclosure of foreign income and assets, even if you pay tax abroad. And relief isn't automatic. You need proof, assessments, withholding statements, residency certificates, dates, exchange rates, the works. 3 FOSS case studies to anchor your strategy. Case number 1, cross-border maintenance. South Africa, UK, Europe. Risk, both countries taxing the same cash flow. Play, check the DTA article for alimony or maintenance. Confirm which state has primary taxing rights, then structure the court order and payment route accordingly. Keep documentary proof, both sides of the ocean. Case number 2, a US pension paid to South African resident. The risk, the US withholding at source and South Africa tax on receipts. Play, verify treaty treatment for private versus government pensions. If US withholds, capture the withholding proof and claim a foreign tax credit on your South African return to prevent double hit. Case number 3, Mauritian apartment in the settlement. The risk, capital gains in Mauritius on disposal and South African taxation on your worldwide gains. The play, confirm the treaty's property article, time the disposal, document foreign tax paid and claim the credit in South Africa. Sequence matters, close, blind, and you overpay. 5 moves that win this game. Number 1, map the flows before you sign. Maintenance, pensions, lump sums, property transfers, list each stream, its source, residence, currency, and treaty article. Number 2, lock down tax residency. Obtain the right residency certificates, South Africa and/or foreign, for the relevant tax years. DTAs often hinge on this. Number 3, draft orders with tax in mind. Be precise. Amounts, frequency, currency, payer, recipient details, and where payments are made. Small wording changes and alter treaty outcomes. Number 4, build the evidence file. Foreign assessments, withholding slips, bank advice notes, exchange rates used, valuations at transfer, and the court order. No proof, no relief. 5, claim credits correctly. Where a second tax still arises, claim the foreign tax credit in your South African return with proper schedules and supporting docs. Don't give the revenue 2 bites of the same apple. Red flags that need a lawyer and tax team immediately. We'll figure out the tax later. You'll pay for that sentence. Mixed assets across 3 or more countries. Government pensions, split annuities or vested benefits. Settlement cash, moving through a third country for convenience. Maintenance denominated in crypto or volatile FX without an escalation clause. Now remember, not every DTA says the same thing. The UK article won't mirror Germany. Australia won't mirror the US. Tiny differences in treaty text can flip the answer and the bill. Here's the ethos. Justice is the law written in ink. Good planning is the law written in numbers. In international divorces, you need both. If you're splitting lives across borders, maintenance, pensions, property, I'll help you map the treaty, draft the order, and keep the Minotaur caged. This is not tax advice. It's your warning bell. Bring your facts, we'll bring the strategy. I'm Simon Dippenaar. Pay once, only once, and keep what's yours by design and not by accident.